Okay, let's just dive right into this because what we just witnessed in the Asian markets is literally nothing short of historic. The KOSP completely plummeted to 7,493.18. Now, if you're just looking from the outside, the mainstream financial headlines are screaming about a complete systemic market meltdown, right? Panic is definitely the prevailing narrative today. But as we dig into the actual data in this explainer, we're going to investigate a classic market collapse, camouflage. We're breaking down this severe liquidation phenomenon strictly from an investor's perspective. We're going to strip away all that emotional noise and look at the highly targeted strategic capital movements happening just beneath the surface.
Down 6.12%. I mean, just take a second to let the sheer size of that number sink in. That is a massive, severe contraction for the composite index to take in a single trading session. When the average market participant sees a drop like this, the immediate psychological reaction is, well, pure fear. It feels like a structural failure of the entire Korean market. But as investors, we have to step back and ask a critical question. Is this a genuine, broad-based exit of capital from the region, or is the broader index being violently dragged down by something much more specific?
Well, the reality on the ground is entirely different from the headline panic. Out of a colossal 5.66 trillion Korean won in total foreign net outflows, a staggering 90.7% of it was concentrated entirely in just two semiconductor giants. That's right, just two. This wasn't some broad, indiscriminate market dump where investors just hit the eject button on everything. No way. The vast majority of the bleeding was surgically isolated right at the absolute top of the index.
So the absolutely crucial point we have to determine today is this. Are we looking at a legitimate market break signal, or is this just incredibly loud noise? Because look, if over 90% of the exit is coming from just two stocks, framing this as a systemic market collapse is a massive misdiagnosis. Instead, we need to treat this as an investigative autopsy of a highly concentrated, camouflaged liquidation.
Section 1. Collapse or targeted liquidation.
The core data separating reality from the headlines really lies in the short ratios. You have this massive 2.50 trillion won net sell-off in Samsung Electronics, right? And a 2.64 trillion won net sell-off in SK Hynix. Those are staggering outflow figures. But the short-selling ratios, they tell the real story here. We're talking 0.71% for Samsung and just 0.54% for SK Hynix. Keep in mind, the broader market average for short-selling is over 3%. These near-zero short ratios prove mathematically that this was not some speculative short attack by hedge funds betting on a crash. No, this was a strategic, deliberate liquidation by existing long-term holders who were simply cashing out.
Which brings us to the hidden liquidation signal.
If existing institutional holders are dumping the two biggest names in the market, we really have to understand their motive. Like, what was the catalyst that triggered this massive unwind? Well, these two giants, Samsung Electronics and SK Hynix, had most aggressively priced in optimism surrounding the US-China summit. They're essentially the bellwethers for global tech trade. The market had heavily leveraged its expectations on the summit, hoping any thawing of geopolitical tensions would directly translate to semiconductor supply chain normalization, and frankly, some much-needed clarity on international tariffs. So when that summit failed to deliver the concrete breakthroughs everyone wanted, these two specific names became the immediate primary victims of the unwind. Foreign capital didn't exit because the core businesses are failing. They exited because a very specific, highly leveraged geopolitical bet simply didn't pay off.
But here is where the camouflage liquidation phenomenon truly reveals itself to the astute investor. While billions were pouring out of the top two giants, pay attention to where foreign capital was simultaneously rotating. We saw a 91.8 billion won foreign net buy into Hana Micron, which actually ranked it first among KOSDAQ foreign net purchases. Plus, we saw tens of millions more flowing into LS Electric, Sanil Electric, and Taihan Cable and Solution. This is a highly specific, hidden capital rotation directly into high-bandwidth memory packaging and AI data center power infrastructure. The money isn't fleeing AI in a panic at all, it's simply moving down the supply chain. Think of it like this. Capital isn't abandoning the AI revolution. It's just quietly moving into the basement to upgrade the power grid.
Next, let's unpack the program selling cascade.
You might be wondering, if foreign capital was just quietly rotating out of two specific stocks and into infrastructure, why on earth did the entire market plunge? Well, chronologically, this builds in a strict, almost mathematical sequence. First, the US-China summit optimism fails. Right after the KOSPI hits an intraday high, step 2 happens. Trump's hawkish Iran statement hits the wires, instantly pushing global oil prices up and completely invalidating the broader rally thesis.
Step 3. Foreign capital aggressively liquidates those two top-cap tech giants. And because Samsung and SK Hynix hold such a massive weighting, their isolated drop mechanically pulls the entire KOSPI 200 index down with them. And finally, Step 4. That sudden index drop triggers a massive 4.47 trillion won non-arbitrage program selling cascade. It's a blind, algorithmic feedback loop that automatically dumps shares across the board, punishing the broader market completely unnecessarily. The sheer violence of that algorithmic feedback loop resulted in an intraday collapse from a high of 8,046.78 all the way down to a low of 7,371.68. I mean, that is a minus 8% drawdown within a single day. The machines just kept selling. It was only after retail investors stepped in to aggressively absorb a staggering 7.23 trillion won in net buying that the shock was finally contained, breaking the circuit and allowing the index to recover just slightly before the closing bell.
Section 4. Tracing the capital rotation.
Now that we've diagnosed the mechanics of the crash, we really need to know if the foundational thesis for these tech stocks is actually broken, or if today was strictly a positioning adjustment. Well, this one macro data point from the Bank of Korea answers that question definitively. DRAM export prices for April grew at a staggering 232.8% year over year. The AI structural demand cycle remains fundamentally intact and robust. Today's drop reflects aggressive, short-term position rebalancing and blind algorithmic cascades, absolutely not a fundamental deterioration of the underlying semiconductor business.
And honestly, just to highlight how completely disconnected today's market mechanics were, we can isolate the LG Electronics anomaly. The stock rose 10.83% today, purely driven by enthusiastic domestic retail buying. But simultaneously, there was 256.1 billion won in foreign net selling and a highly elevated 5.93% short ratio. This is a perfect example of an isolated, thematic retail positioning play driven entirely by retail hype ahead of the JP Morgan Tech Conference and Boston Dynamics IPO expectations. It is completely unconnected to the heavy global institutional flows we've been tracking.
Let's move to validation in U.S. markets.
So we know exactly what happened in Asia. Now we pivot to execution mode. This is the critical baseline number you need to write down right now. 29,261. This is the Nasdaq 100 futures price recorded at pre-market 5 a.m. Eastern Daylight Time. This isn't just a level, it's the absolute fulcrum to the rest of the trading week. Everything going forward hinges on how the U.S. market behaves relative to this exact price point. If the Nasdaq holds above 29,261 tonight, it officially validates that the massive Asian selling was exactly what we suspect, a temporary, one-session position unwind. It confirms that the hidden capital rotation into HBM packaging and AI power infrastructure is a real global trend. If we see this level hold, the action to take is to immediately monitor the equivalent U.S. HBM supply chain and data center power names. However, if the Nasdaq breaks below this level, that entire Asian recovery thesis breaks right along with it, and we have to rapidly reclassify that Korean selling as a broader, structural exit from emerging markets altogether.
Finally, the macro invalidation risks.
This is the final, and frankly, most dangerous piece of the puzzle, the higher-order global macro variables that threaten to destroy this entire rotation thesis. Listen closely to these hard thresholds. If the US dollar index sustains above 100, if the 10-year Treasury yield spikes above 4.6%, or if geopolitical escalation pushes Brent crude above $110 a barrel, if any of these higher-order variables hit, they will trigger immediate global inflation reacceleration concerns. The result? It fully invalidates the Korean AI rotation signal we just mapped out and instantly activates a structural, sustained emerging market exit framework. You have to watch these levels tonight. They are the ultimate referee of market reality.
So the financial headlines are going to keep screaming market collapse. But as we've seen through the data today, the reality is a surgical, highly strategic capital rotation masked by an algorithmic panic. The question you have to ask yourself tonight as an investor is this. Are you going to be the individual reacting blindly to a 6% index drop? Are you going to be the one tracing the billions, quietly moving into tomorrow's infrastructure? If you want to stay ahead of these hidden market mechanics and receive news on the closing of Asian stock markets before the New York opening bell rings, please subscribe.